Rick Dulai, Remax Metropolitan. What to expect with the appraisal? In my experience, buyers and sellers have a huge misconception about the appraisal. The simplest and best way I can describe the purpose of an appraisal is for the lender to justify their investment. It is not to prove that the seller has negotiated the best price or for the buyer to prove how much equity they are receiving. So what does that actually mean? Well, let's start with the buyer's equity position. I have noticed that the appraisal usually comes in at or around the agreed upon purchase price. This is not a coincidence that the buyer and the seller have somehow magically negotiated exactly the appraisal value. Instead, the appraiser is justifying, if the evidence supports it, the bank's loan to the buyer to purchase the property. Essentially, the appraiser is just telling the bank that if the buyer were to default on the loan, the bank could take the home back and sell it and recover their loan amount. And this is especially critical when the buyer is putting less money down. For sellers, on the other hand, they often wonder if they've left money on the table. So they are always curious to know, what did the appraisal come in at? However, the appraisal itself is paid for by the buyer and is required by a lender. It is really only for their information. If they decide to not share the appraisal, that's their right to do so. Typically, the lender will just report that the property appraised and that they're going to move forward with the loan process. Now, sometimes when the buyer is purchasing the property well below market value, the appraisal can come in much higher, indicating a lot of equity to the buyer. However, typically in those situations, both the seller and the buyer know what's going on and there's no surprises. The bigger issue is actually when the appraisal comes in low. And in that case, any of the following could apply. Number one, in order to proceed with the loan and the purchase, the buyer is going to have to come out of their own pocket for the difference in the appraisal amount and the purchase price. Number two, the seller could just reduce the purchase price in order to keep this buyer on the hook and not lose the deal. Number three, the seller and the buyer could agree to split the difference in varying degrees. And number four, the buyer could just kill the deal because they don't want to do any of the above. And according to most purchase agreements, it is the buyer's right to do so. A finance contingency is based on a loan approval which requires it to appraise at value. In this case, the buyer is going to get their earnest money deposit back, the EMD, and can just decide to move on to another property. I hope this video helps you understand a little bit better about how appraisals are related to your transaction. If you have any questions, please feel free to reach out to me at any time. Thank you and have a great day.